Hello and welcome to Investors Hangout. Wish you all a very happy new year. This fortnightly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, at a time when rising inflation has become a global concern and the Central Bank of United States has also hinted at a possible interest rate hike, are you wondering what that means for you and your investments? Well, to help us understand that and much more, we're joined by our CEO, Dhirendra Kumar. Welcome, Dhirendra.
Thank you.
Dhirendra, there's been a lot of hype in media about, a possible interest rate hike, though the government maintained the interest rate for small saving schemes. The SBI hiked base rate by 10 basis points. So does that mean an interest rate hike is imminent? Also, if you could please explain what is the relation between a US Fed rate hike and an interest rate hike in India?
No, first is that, there is a link between rising inflation and interest rates. Central bankers try to prop up the economy by reducing interest rate when the economy is struggling. But the other side of propping up the economy is that that is done by creating greater liquidity, by supplying more money into the economic system, and the result of that is rising inflation. Too much money chasing too few goods, so that actually leads to prices going up, and that is not good for people in general. It is referred to inflation as it is tax. It's the worst form of tax for the poor, because taxation is discriminatory. You have higher taxation on cars, and people earning more, they pay higher rates of tax and things like that. But when it comes to inflation, it affects everybody equally. So in that sense, it is considered to be bad. And it is considered to be very bad for the poorest of all. So governments get concerned, central bankers work towards reducing inflation or having inflation in a manner that it is manageable, it is not hurting the general sentiment. Then comes, Fed rates and the Indian rates, the linkage. We are living in a global financial system. The money flows, money is fungible. Foreigners, portfolio investors are investing in India. So if there is something which changes, it has a repercussion. If interest rates goes up, in the US, investors will pull out money. Their opportunity cost of money will go up, and their expectation from that money, assuming that your interest rate in US was 2%. So if you earn 5% in India, you'll be very happy. But if it goes up to 4%, 5% will no longer be, making you happy. You would like to have a greater risk premium for investing here. So your expectation goes up. And if your expectation goes up, and if it is not met, it will be disappointing, and investors will pull their money out in hordes. So in that sense, it has an impact. How strong an impact? Foreign investors are not a very significant investor in our debt market. Also, it might have an impact on the equity market, and it is beginning to show. Like last 2-3 months, we have seen that foreigners are pulling out money. But at the same time, the dynamics of our market has changed. Now, a large number of domestic investors investing in the Indian market.
Plus the EPFO and
the national pension system, and the domestic investors putting their money in IPOs, putting their money in SIPs. The SIP book has gone up to something like 10,000-12,000 crore a month, which used to be the FII inflow every month few years back. Besides that, individual investors are participating in the market very significantly. They are investing in stocks directly. And that is all contributed by a variety of things. The variables which is driving investors to invest in the market is not going to change. The first biggest change is the interest rates are low. People are not getting enough return on their money. So, people want to assume some risk, and they want to assume some risk, generate more return, and that is what is, attracting people to the equity market. The second is the convenience. Earlier, it was a nightmare to be investing in the market. Now you can do it, you can get started in 10 minutes. If you have a smartphone, Aadhaar card, and an online bank access, you can start and do it in 15 minutes. And of course, the market should be open too. So that is actually attracting a lot of people. Maybe a lot of people are not investing in the right manner. They will learn on the go. They will learn on the curve. But I think that there is a learning curve to all this. A lot of people might be thinking that they are investing, but they are just speculating simply because the market has been favorable. But they will learn. So my sense is that it will have an impact. How significant an impact? I don't know. But looks like we have been able to create an environment, domestic environment, which is extremely favorable, and we may not be as badly hurt as in the past. There is an event which was called Taper Tantrum. Sometime around May, June 2013, Ben Bernanke, the Fed chief, he said that he's thinking of increasing the interest rate, and that itself led to a catastrophe in the global financial market. Our rupee depreciated by 15% in a span of two months, and that was the first time we at Value Research were in for a shock. That particular day when it happened. Next day, domestic mutual fund, all our liquid funds and even ultra short-term bond funds, which have never fallen on a one-day basis, they went down in value. That was a catastrophe for our financial market. And that was a catastrophe also because we were extremely dependent on the foreigners' money, not as much today. If you remember, the global financial crisis 2008, Indian markets went down by 55%. In a span of 4 months, from January 21st to May in 2008, the market market on the Sensex went down by 55%, which was unusual, unprecedented, and that created, because once the market gets into the negative spiral, people don't look at value, people don't look at valuation, people don't find something, people are not logically guided. They just think that it is time to run. So earlier it used to have a significant impact. Now I don't know how we will be tested, but looks like we are much better placed today than we were earlier.
And is the interest rate hike imminent, do you think?
Interest rate hike is imminent simply because no government would like to. Till about 3 years back, Indian government and Indian central bankers were targeting inflation. They used to put target on inflation, that how they have to hammer it down, because that is actually a very big socio-political economic issue. If here in India, government falls simply because onion prices are high, or if the narrative is built around that, okay, prices are going completely out of hand and it is going to hurt everybody. So now we are finding that inflation in India has been so much in control. It is a result of 5 years of work by the central bankers. They have been targeting inflation, and now we have far greater. And the supply side, many a times the inflation goes up simply because
less
supply, or it is not even supply. And many of those economic rigidities, economic constraint that we have been used to in the past, they are getting resolved.
But there's a sentiment among people that interest rate hike is not a good thing for them. That's the general sentiment. Can you explain why is that so?
Inflation being very high is not a good thing, and interest rate going up to manage or to control the liquidity in the system is also not considered good thing. Is considered a good thing for the economy in general, because the cost of capital goes up. Businesses will be reluctant to borrow. A reluctance to borrow will lead to not increasing the capacity. Then interest rate going up, corporate profitability comes down because companies borrow money, and that money generates some return, and then calculating the profit, you have to pay the interest on the capital that you have borrowed. So if your interest rate goes up, your profitability comes down. So that is the short-term thing. But I would say that if it is to be done to manage inflation, it will be done. And I think investors need to really think more, because these are things on which investors have no control. You have to really manage the manageables. And you can't do anything about the global inflation. You can't do anything about the pandemic, which led to the unleashing the liquidity in the system to restore confidence, or to ensure that the economy doesn't really comes to a grinding halt. So we don't have a control on all this. I think it is important for investors to control the controllables, which is have a plan which is flexible enough. You are not extremely dependent on the short-term outlook of the market. and don't speculate.
Then how does it affect individuals?
Two sides to it. One is that, if you have old parents and they have invested their money, they have been suffering. The interest rates are so low that they are struggling with the income that their investment used to generate, so that they will benefit. The other side of this is that you will have some youngsters who have borrowed money for their housing loan or for their car. So that interest rate goes up, they will suffer. So in that sense, interest rate goes down, one of the two segments, because there is in an economy, you have a set of people who have the surplus, you have a set of people who are borrowing.
Yeah.
And depending on where you stand today, many a times, cheap money leads to unfair, less thoughtful borrowing. Those investors should really get out of it. You just go to a shop and do a 20,000 rupee impulsive shopping simply because easy credit is available. I think that is something which one should generally, as a prudent financial policy for an individual, it is avoidable. Even if the interest rates are very low, even if they are zero, simply because because you are actually mortgaging your future earning for that. Of course, you should borrow money for a home loan because you are building an asset. One should not be borrowing to spend it, is the basic personal finance rule, which everybody should stick to.
And how will it impact the debt mutual funds?
Debt mutual fund, there is an inverse relationship. So an inverse relationship of a different kind for different kind of debt funds. The bond values go down in value, bond prices, if interest rate goes up. And the simple reason is that if I hold a 10-year bond, which will be yielding something like 6%, and a new issuance will actually get me 7%. So I will be lowering the price of this older bond, which will keep yielding me about 6% for next 7-8 years. So longer the maturity, bigger the fall. So to insulate oneself from such big decline, don't get into the long maturity bond funds. But at Value Research we keep saying anyway, that be into liquid fund, be into ultra short-term bond fund, and be into short-term bond fund, and nothing beyond that. So if you are actually following our advice on that framework, you will be insulated from the risk substantially.
And what about target maturity debt funds?
Target maturity debt fund, you have to see that, if it's a fund which is designed where investors will not pull out money, which means that even if the interim value goes down, even if the value goes down in the interim while you hold it, it doesn't matter, because you will get the return that was expected at the time of investing.
All right, time now to move on to our viewers' questions. And the first one has been sent in by Nirmalya Biswas, who has just retired from government service. Nirmalya wants to know if you would suggest waiting until a rate hike to invest his corpus.
I would say that, you can't really wait, because you need to generate, your money will remain idle. So invest somewhere. If you have to wait, then maybe invest in an ultra short-term bond fund. Invest in a very safe ultra short-term bond fund, which has 90% of its money in AAA bonds, so that your money starts earning, because this will be if this is a meaningful amount of money. Even otherwise, I think, the first port of call for any retiree will be, senior citizen savings scheme or post office MIP. There the interest rate did not go down, so they are unlikely to go up in a hurry. And they did not go up on 1st of January, so they are revised every quarter. So, the first tranche of your investment, which should be any retiree's investment, invest that anyway, and the rest of the money you can plan accordingly. But a retiree's money should be invested with a far greater planning in terms of how much money you need on a regular basis, how much money you never need, but you want it to grow reasonably with a fairly, without taking much chances. So it requires a little bit of planning, and that translates into, taking an asset allocation, that how much of your money should be invested in equity, how you should be investing in equity. Depends on have you ever invested in equity? Are you acclimatized to the madness of the equity market? If not, then it requires a different approach in terms of investing in an equity income scheme, which is a very conservative take on taking the equity risk, yet conservatively. So requires careful planning, think through it.
Now, 72-year-old Nitin Patil is a farmer. He accumulated 20 lakh rupees through bank fixed deposits, but now the return is very less. So where should he invest to get a higher return? He's looking for moderate safety and growth.
One is that, for people like him, the interest rates will go up, and that will benefit him a little bit, but not meaningfully, because even if interest rates go up by 8-10%, the decline, a lot of times people haven't carefully looked at the decline in interest rate. If interest rates came down from something like 8.5% to which most Indians have been used to in the last 10 years, if it came down to 6%, it looks like 2.5% decline, but it is not 2.5%. It is more than 25% decline in your earning. Even if you have 1 crore rupee of capital, you were earning 8.5 lakh rupees 5 years back, and now you are earning 6 lakh rupees. So at a time when inflation is going up and your income has come down by a lifetime of hard work, the return on your capital has come down by 25% or more than 25%. That is devastating. That is quite scary for many people who get dependent on their income. So they need to really, they don't have a choice. They have to really calibrate their investment. They have to invest in equity. That is the only promise. But investing in equity comes with its own set of risks. It requires understanding. It requires calibration. So to begin with, I would say that, start with something like of his 20 lakh rupees, target to invest 2 lakh rupees into equity, and then spread that investment over the next 10 months. I'm just doing a simple mental calculation that, okay, 2 lakh rupees to be invested in 10 months, so you are investing 20,000 rupees. That way you will be able to invest which has a promise to beat inflation by a wide margin. And then gradually, once you get used to it, maybe next year invest some more. Maybe take the allocation to 25%, 30% of the total money, which will be about 4-5 lakh rupees invested in equity. That is the only, and invest it steadily. Don't invest at one go. I think that is the only way where you will be able to, build some kind of cushion against inflation and falling rates.
All right, Ramakant Sabu asks, what should be our investment strategy considering the recent Omicron threat? Should we move from equity to debt?
We don't know. And if you actually take my suggestion, either way, you just might be in for a surprise. I might mislead you. That is what happened in March 2020, when a lot of people got scared and the market was on a free fall. Market went down by 20% in a span of 2 weeks. And a lot of people actually pulled out. And after that, we have seen the unprecedented gain. So equity markets will be like this only. They might scare you, but if you are investing for the long run, if you don't need, if you are unlikely to need this money for real need for in the next 5 years, don't bother about it. If at all you have to do something, then maybe work on your asset allocation plan. That you will always have 20% of your money in equity, in fixed income, or 30% in fixed income. Move that money to fixed income today, so that if there is a big change, you can rebalance it and profit from it. But otherwise, I would not suggest that you should be thinking in binary terms that should you pull all your money from equity to debt or debt to equity. And if you do it very strongly, you are most likely to be wrong.
Anisha Mittal wants to know, how does an index fund work for long-term investments? Can one invest in them for short-term goals also?
One has to look at it as an equity investment. And when investing in equity, you have multiple ways of investing in equity. It could be 20% equity in an equity income scheme, or it could be 50% equity in an equity balanced advantage fund or something like that, or a balanced fund. Then you have a diversified equity fund, a flexi cap fund, or a multi cap fund. Then you have this index fund, which will be investing in large caps or mid caps, depending on which index fund you are choosing. And it will have a lower cost, and it will be managed in an automated way, that it will always be replicating the index. It will have a lower cost. So when investing in equity, one should never think of any period less than 5 years. If it is any period less than 5 years, you are investing in equity. You are choosing an equity which is getting invested in a pre-programmed manner. When you are investing in a Sensex fund or a Nifty fund, you are assured that, okay, your 10,000 rupee which is invested, this much percentage will go into the top company, this much percentage will go into the second company, so on and so forth. You know what it will be. But index funds also, when I look at the index or Sensex in particular, which has a long history because it started in 1974. Since 74, there has been a period of 7 years in which you never didn't make money. If you catch the worst time period, so my sense is that if you invest and invest regularly, you are unlikely to be a loser with a 5-year holding period.
Okay. Now, Sharik Ahmed Khan Niazi has sent in the next question. He has earned a return of almost 100% on his equity investments over the last 3 years. So, should he now shift to a liquid fund?
Oh, congratulations! But 100%, investments going up by 100% in 3 years is, great thing. And this has come in a context at a time when nobody expected it. So the fact is that I don't know. One is that if you don't have enough time, if you are not going to remain invested for another 5 years at least, you should take a part of your money, the money that you are likely to need in the next 2-3 years. If it is a long-term money which you are unlikely to need for 5-10 years, remain invested because nobody can guess it. And we have been all wrong in the last 2-3 years.
Also, does it make sense to pull out all the money and then shift to a liquid fund?
No, never. One should always, there are 2 reasons when any investor should actually take his money out. One is that if you have achieved your goal, you thought that, okay, you will continue investing for next 2, 3, 4 years, 5 years, 10 years, and once it accumulates to this much, you will take that money out and buy that car. You will take that money out and buy that home. If that has been achieved earlier than expected, take that money out and have it. Go for your spend or consumption. Second reason is that you chose a fund and you thought that it will be doing nicely like this. And after you invested, it has stopped doing like that. And there are other alternatives which are behaving better. You like them more. They are proving to be more stable. Or in any of our analytical framework, they have flipped on the rating dramatically. Or we have something called analyst choice, something which was part of the analyst choice and it is no longer part of the analyst choice, and that is for a reason. And sometimes it could be for a real damning reason. So pull that money out and move that money elsewhere, move that money into some other fund. But that is, you are not pulling out, you are actually changing your fund.
Yeah. The next query has been sent in by Shekhar Rajadhyaksh, and he asks, what is the difference between a multi-cap and a flexi-cap fund? Which one is better?
The key difference is that the multi-cap funds are necessarily always, by the design of it, ever since SEBI actually defined the formula, the way they will be investing, that multi-cap fund must have 25% into large cap, 25% into mid cap, and 25% into small cap. And that large cap, mid cap, small cap is also well defined. Top 100 companies large cap by capitalization, next 200 mid cap, and subsequent ones are all small caps. So they are necessarily diversified, and then the remaining 25%, the fund manager has the discretion of spreading it wherever he wants to. But the minimum stipulation of investing at least 25% in each makes it necessarily a diversified one, and I think it's a good vehicle. Multi-cap funds or the flexi-cap funds, where the fund managers have the flexibility of investing. They are supposed to invest in all of it, but they have the flexibility. They choose to not to invest in large caps at this point, but at a later point, they will have the discretion of investing wherever they want to. So if there is a thoughtful, credible fund manager who has built a great track record by being a multi-cap, a flexi-cap fund, go for it. But if you want to be, and there is a problem of the flexi-cap fund that, once they become very large, they generally tend to avoid small caps because it is very hard to invest. Assuming that there is a 30,000 crore fund, and if it has to invest 7,500 crore in small caps, that is hard for them to do and manage that portfolio, because small cap companies, you cannot invest large amount of money. There is a liquidity issue. There is a liquidity issue at the time of buying, and there's a liquidity issue, or there's a huge impact cost at the time of selling. You think that, okay, the small cap company has gone up in value and you want to sell it, you may not find a taker. Or when you want to build a sizable position, you want to invest 400 crore in a small cap company, that act itself will drive up the prices. So building a large small cap portfolio is hard, difficult, and it is more difficult in a multi-cap fund, in a flexi-cap fund, where he has to necessarily invest as it gets larger.
Bhaskar Agarwal asks, is it a good time to invest a lump sum for the long term? He plans to invest in a high-rated aggressive fund.
it is always a good time to invest in equity for the long term. Now, investing lump sum, is it a good idea? No, because a large amount of money when invested at one go, the problem is that we ourselves become very anxious. You know, if I invest 50 lakh rupees in an equity fund and maybe a small cap fund and two great small cap funds, but the nature of the beast is that when market goes down, it will go down by 10%. And that is quite unnerving. If you are not getting upset by that, by all means you can well do that if you're going to hold it for next 10 years, 5 years. But I don't think, for keeping your sanity in check, it is always good to be spreading your investment.
Today's last question has been sent in by Deepak Gudgutia. He wants to know if fund of funds are good and if it's sensible to invest in them.
Generally not, but in some cases it doesn't matter. When I look at all the international funds where there's a great fund and it is actually a fund of fund, it doesn't matter. In case of domestic fund, I have my apprehension. One is that these funds the tax treatment is like that of a debt fund. The other is that it adds to the cost. You will have the expense of the underlying fund and you will have the expense of the fund of fund as well. So, and I don't think it is a substantial value addition so that you should incur this cost. So domestic fund of fund, avoidable. International fund of fund, it doesn't matter because they're going to be treated as debt fund anyway. And then, so you can have, and that is the design, and you're actually getting into a specialist vehicle in which you participate.
All right. Well, with that, it's a wrap on this episode. Thank you.
Thank you.
Thank you to all our viewers. Do keep sending us your questions. Keep watching this space for more information. And if you like the show, do subscribe to our YouTube channel. Thanks for watching. Bye for now.